So we're getting ready to talk about the standard deductions and how to beat them since they've changed from prior years. Just going to go over what they are. But before that, got to give the introductions. So from my brother, always supporting with the real love, we got R-Real here.
Yes, yes. What's up, everybody?
And then we got the King of Dreams. We got Joseph.
Oh, boy.
Joseph in the building.
Hey, how's it going, people? Nice to meet you.
Alrighty. So, anything else you guys want to share about yourselves before we get into this?
Graduated from Langston University in 2015. Got my degree in business administration. I've been doing taxes for 6 years now. 6 years.
You can't be modest. You gotta tell them what status in which you graduated. You wasn't no regular graduate.
Yeah, cum laude of my class. Cum
There you
laude.
go.
Shout out to Langston University.
All right.
That's incredible.
Thank you.
I'm a graduate of Cal State LA. I studied political science and philosophy. Shortly after that, I externed with two judges, and then I began working at a law firm that specialized in high net worth taxes for the ultra high net worth as well. And that's where I kind of got exposure to taxes and filing status and what is income and what is taxable. And so now I'm planning to be a CPA and eventually a tax attorney, just like those people I studied under. So.
Okay, yeah.
So that's pretty much your world now, huh? Taxes.
Yeah,
Gotcha.
it's a beautiful world.
It's good. Bunch of pluses and minuses. But yeah, we're just gonna go ahead and get into the standard deduction. Just name it off. If you've been following along in the previous episodes, we've gone over it a few times, but it is detailed information that is valuable from the W-4 to the 1040. And we're pretty much going to talk about itemization. So that is pretty much the only way you're going to be able to beat the standard deduction. But there are creative ways to ensure that you're doing that for those who are able to do it. Because not all are able to based on your income.
Exactly.
So you're not able to just freely do these things.
And your occupation. Your occupation. In order to itemize, you have to have a job where it, you know, you're buying a uniform, you're buying supplies, you're buying food, you're buying things that could add up to exceed the standard deduction, which is, you know, for a single person, it's around, well, it is 12,000. So you got to come up or spend enough money through the tax year to exceed that. So.
Yeah. And it also goes along with the married filing separate status. It is also at 12,000. We have the joint filers, those who are married, is 24,000. And then head of household, as we said before, if you're single, you cannot say you're the head of your household. It is only if you have a qualifying child, you will be considered head of household, and that is 18,000. So we're just going to get into some creative ways to exceed that, to lower your taxable income and your overall tax liability that is set to be paid after you file your taxes. So the first thing that I was able to come up with and able to help you avoid that standard deduction is, of course, the home mortgage interest. So for those who are homeowners, you can use the interest that has accrued, but you've also paid on, to use that as a potential write-off. Now, we're not able to do it as freely as we were before because the tax laws did change. They call it SALT, and it caps you at 10,000. So that gets you, depending on your status, almost there.
You right there at the brim.
Yeah, you're almost there.
2,000 ain't nothing.
So if you're single, you just got $2,000 more to go.
As you can see, I'm thinking from the single perspective. I'm like, I can lie about 2,000. No, I'm playing.
But I can't get away with 8,000 because I'm head of household right now. So no, that's a big chunk of change, and I don't even own a house, so it wouldn't qualify for me at all. But it is one method for you can deduct the state and local taxes up to $10,000. It's only $5,000 if you are married and have decided to file separately. So always beware of the limitations when you're going ahead and claiming that as a deduction to help you exceed the standard deduction. The other one I was able to research. This one I researched a little bit because I'm not too familiar with it, but you can account for effectively your capital gains and losses. You can also use that to help exceed the tax deduction. So that is one good thing. I'm just going to read off of Investopedia. The maximum federal income tax on long-term capital gains is 15% for most individuals. It can reach up to 20% for higher income levels. And then you have that the 3.8 net investment income tax also applies to higher income levels as well. So what you're able, with the losses that you take on the investments that you've made, you can use that as those losses to losing a train of thought now. See, that's
to add to the number,
to your overall number, to exceed the standard deduction,
yes,
which could be 12,000, 24, 18, 350. So yeah, that is another way to do it, and the one that I like the most is to give. I've said it plenty of times.
charitable.
You got a hand to receive and you have a hand to give. So for me, to do the simplest thing is, say you're single, is 12,000. Just divide that by the months, which is $1,000 a month, pretty much. So if you're able to give $250 every year, you're going to exceed your standard deduction, whether it be given to a church, given to the Goodwill, Salvation Army, any of those nonprofit organizations. You would give to, if you're able to go ahead and give and support those groups and their missions, you'll be able to reap that benefit by exceeding the standard deduction in your giving. So that is another avenue, another way to ensure that you lower your taxable burden, and pretty good, I think. It's always good to give unto the Lord. So you got that 10%. Go ahead and support your local church and the different things that they are doing within the community. So those are the things that I pretty much came up with, one of which I researched, as I stated, to avoid the standard deduction, because it is not as easy to beat it, because they increased it, removed personal exemptions, and things of that nature. So anything you want to go ahead and you guys want to add?
I think, like I said, for the specific jobs, teachers is huge. If you can do it, if you are a teacher, for sure. Truck drivers, boy, y'all can definitely still do this. If you are, we know the business owners, if y'all can get up there, that's for sure, but you do have to keep all of your receipts, because if you do a Schedule C, most of the time that's what they're highlighting. That's one of the things that the auditors highlight, is if you have a Schedule C attached, they are going to review those documents. So please either take advantage of QuickBooks or keep those receipts and do it the old-fashioned way, and have proof for if the time comes and they are going to audit you, you want to have proof. But so if you're a teacher, if you're a truck driver, if you're a hairstylist or a barber, and then of course itemize your deductions and try to beat out that standard deduction. But if you're not any of those, it's going to be hard, not saying that it's impossible or anything like that, but it'll be difficult. And most of the time, the standard deduction will be the best thing for you to do, because you probably won't exceed that $12,000 mark.
But you said something pretty good, as far as keeping your receipts, staying on top of your books. For those that are out there that are more interested in running your business and not having to deal with the financial reporting and all that stuff, oh, you can holler at me and the Wilson Financial Company. We do bookkeeping for a lot of different companies. We do use QuickBooks. I do personalized reports through Excel, because the key is to put a report together that you will be able to understand, but me also that prepares you to easily help file your taxes. So we understand that there's a thin line between paying your taxes and then showing enough income to allow your business to grow through lending. So we specialize in that. We have a few people on the team that will cover the taxes.
Yeah.
Got my brother right here. I'll be doing the bookkeeping, and then we have a business manager on board, and we're waiting for this gentleman over here to go ahead and get his CPA, become a CPA, so that way he can audit the things that I'm doing. So we double check and triple checking the work. So yes indeed. So good. I like that transition. So focus on your business.
Yeah.
We'll handle the reports.
Yeah, and I think also for, in regards to deductions, it's kind of difficult when you're married to beat the standard deduction by itemizing.
Yep.
But there's always things that happen. Like, for example, we recently had a car accident, and those medical expenses can also be deducted if they're greater than MAGI. So that's also one thing to look at. Also, some student loan interest. Yeah, you might want to get those together and just aggregate as much as you can so that you can beat out that standard deduction. Especially with property values being so high in California, your interest already puts you to that threshold. So even if it's capped, there's other things you can do to beat it out.
Most definitely.
It is frustrating for those homeowners. I do hear it, I do sense it, and I do see it. And we'll see what happens moving forward. There are a few states that have been compiling quite a few prestigious lawyers to attack the government to get that law changed, if anything, reversed back to what it was before.
Plus, there's re-election.
Yeah.
So
pay attention to what all they're proposing. Choose your right candidate. Hope for the best.
re-election coming
So
soon.
yeah. So those are all good things, good information to use. But yeah, we'll see what the court says, see what the government says when it comes to those property taxes. Because I know pretty much everyone in the state of California is hurting in some way or another to be losing out on 10,000, 20, 40,000 for those who are in the business of property management per home. That used to help you out. Now you're only stuck with one, and not even the full thing in some cases, because you're capped at 10,000. It could be more than that, depending on where your house resides, the type of market that it's in. So, anything else you guys want to add on to the standard deduction? How to beat it?
Just check form 529 on the IRS website. There's some good tips too in there. See what can be deducted.
I think we pretty much touched on the most common ways.
Yeah.
So if you want more information, again, you can just head over to that publication by the IRS. It's always good to read. Reading is the key to success and unlocks many, many doors, and you'll be able to use that information to benefit yourself.
Form 529 on IRS.gov.
IRS.gov.
529.
So that's going to conclude it. It's a short one for you guys. We're going to continue on, head on to another topic. But any questions, any concerns, whether it be about financial literacy, any questions about taxes, about budgeting, effective budgeting, about what an ETF is, whatever the case may be, shoot it over to info@wilsonfinancialmgmt.com. Again, that's info@wilsonfinancialmgmt.com. Responses will be on the Patreon.
Hey.
So join the Patreon, the Dub Club. As low as $5 a month. That's
Yeah.
all it is. That's $60 a year
Yeah.
for all of the wealth of information that we're going to provide to you to benefit yourself. You don't even have to be a client of ours, and you'll be getting that information as low as $5 a month. So head on over there, support us. The more you support us, the more content we're able to give you, the more type of information we're able to send you. And you'll be able to get some pretty good deals on the merch coming soon. And if you love us so
boy.
much, you get consultations for free. So free is always good. Alrighty, till the next one.
See ya.